The financial markets are supposed to be the fairest arena in modern capitalism. Millions of participants, from pension funds to retail investors, all supposedly competing on the same field. But beneath the polished language of liquidity, efficiency, and innovation, there is a world where speed is power, where microseconds decide winners and losers, and where the line between aggressive strategy and outright fraud can disappear in plain sight. This is the world of high-frequency trading, or HFT. A market structure built on algorithms, colocation, fiber optic shortcuts, and machines that can place and cancel orders faster than a human can even blink. Supporters call it progress. Critics call it a rigged race. But the most dangerous part is not just that HFT can dominate the market. It is that the architecture itself can be abused in ways that are difficult to detect, easy to disguise, and devastating to everyone else. To understand the fraud, you have to understand the battlefield. High-frequency traders do not operate like traditional investors looking for long-term value. They hunt tiny price differences across exchanges and instruments, exploiting speed, order flow, and information asymmetry. A large part of the game is built around seeing demand before everyone else does. If a fund wants to buy millions of shares, that intention can leak through the market like blood in the water. HFT firms are built to spot that signal, race ahead of it, and profit from the movement they help create. That alone may sound ruthless, but not necessarily illegal. Markets have always rewarded faster information. The fraud begins when speed is used to deceive. One of the most notorious tactics is spoofing, where traders place large orders they never intend to execute, only to cancel them once the market reacts. Those fake orders can create the illusion of demand or supply, pushing prices in the direction the trader wants. Another tactic is layering, which involves stacking multiple deceptive orders at different price levels to manipulate perception. The goal is not to trade fairly. The goal is to move the market by lying to it. Then there is quote stuffing, a flood of orders and cancellations designed to overwhelm competitors and slow down their systems. In a market where milliseconds matter, forcing rivals to process useless noise can create a tactical edge. It is like clogging a highway so your own car can slip through an empty lane. The market still functions, at least on the surface, but fairness is gone. The participants with the best engineering, the best connections, and the least scruples can distort the environment before anyone else realizes what happened. What makes this world even darker is how hidden it is from ordinary investors. Most people do not trade on raw exchange data. Their orders are routed through brokers, internalizers, dark pools, and market makers whose incentives may not align with the customer. If a retail investor submits a trade, that order can become a source of information before it is ever fully executed. HFT systems can anticipate where the market is going, not because they are smarter in a traditional sense, but because they are positioned closer to the feed, the order, and the action. This proximity creates a powerful temptation. If you can see enough of the flow, you can exploit it. If you can exploit it without leaving an obvious footprint, you can do it again and again. That is why so many HFT controversies sound less like classic fraud and more like technological camouflage. The systems are so fast, the code so complex, and the transactions so numerous that misconduct can hide inside normal market activity. By the time regulators reconstruct the event, the trail is already cold and the damage has already been priced in. The 2010 flash crash exposed how fragile this machine can be. In a matter of minutes, U.S. markets plunged violently before recovering almost as quickly. Stocks collapsed, liquidity vanished, and prices detached from reality. Many blamed the interaction between automated systems, where selling pressure triggered more selling, and market makers stepped back when conditions turned toxic. The incident showed that when speed dominates structure, the system can become unstable in a way that is invisible until it breaks. But instability is only part of the story. The same mechanisms that can fail catastrophically can also be bent for profit. One of the major accusations against certain HFT firms is that they use access advantages that amount to a hidden tax on everyone else. Colocation lets firms place their servers physically near exchange matching engines. Direct data feeds give them faster access than slower consolidated feeds. Sophisticated routing allows them to detect and react to order flow before the broader market sees it. Officially, these are competitive advantages purchased through technology. In practice, they can function like a private intelligence network inside a public marketplace. The fraud question becomes sharper when firms allegedly use manipulative tactics while claiming to provide liquidity. Liquidity sounds beneficial. It suggests markets with tighter spreads and easier execution. But if the liquidity is fake, fleeting, or strategically misleading, then it is not a stabilizing force. It is bait. A market filled with deceptive orders can look deep and healthy on the surface while actually becoming more dangerous for genuine investors trying to buy or sell at honest prices. Regulators have tried to keep up, but the enforcement battle is uneven. Proving intent in a machine-driven environment is hard. A suspicious sequence of orders may look like strategy unless investigators can show it was designed to deceive. And even when penalties arrive, they are often treated as a cost of doing business. That creates a moral hazard. If the upside from manipulation is massive and the downside is manageable, the system quietly invites abuse. The deeper issue is structural. Modern market design rewards speed so aggressively that it creates an arms race. Once the market is built around latency, the players with the most resources will spend absurd amounts of money shaving off microseconds. Fiber lines get shortened. Servers get relocated. Microwave networks are deployed. Algorithms get refined to hunt patterns invisible to human traders. In that environment, ethics can become a secondary concern to survival. And when the reward for winning is access to massive volumes of money, some firms will cross the line without hesitation. This is why high-frequency trading fraud is not just a story about bad actors. It is a story about a system where the incentives point toward abuse. A system where speed masks intent. A system where complexity protects the guilty. A system where the market can be manipulated not through brute force, but through precision deception at machine speed. For the average investor, the lesson is brutal. The market is not always a neutral price discovery machine. Sometimes it is a battlefield shaped by invisible hands, proprietary code, and institutional privilege. The winners are not always the smartest in the old sense. Sometimes they are simply the fastest, the closest, and the most willing to exploit the rules before anyone can rewrite them. And that is the real danger of high-frequency trading fraud. Not merely that it cheats in isolated cases, but that it exposes a modern financial system built to move faster than accountability. When markets become too fast to police, fraud does not just slip through the cracks. It becomes part of the architecture.